Well, as a small investor, we all have literally thousands of low-cost investment options at our fingertips. But will too many options actually hurt your portfolio? Joining me now, Joe Duran, CEO of United Capital Financial Advisors and author of The Money Code, Martin LeClaire, Principal and Portfolio Manager for Backyard Advisors, and Alan Haft, author of You Can Never Be Too Rich. Alan, I'll start with you. So 8,000 ETFs and mutual funds out there. Can you have too many?
You absolutely can. I mean, Jerry, think about this. You and I go to Las Vegas and we put $10,000 on a roulette table and we cover all the numbers. There's always going to be winners and losers in there, and it's a zero. And too much diversification is definitely a recipe for certain minimized returns. So, the simpler somebody makes it, the more effective a portfolio is always going to be, because you can rebalance it, you can understand what you're investing in, you can watch it, and not be so confused with all the different things you have out there.
Martin, you know, there's going to be a Bitcoin ETF, and we talk about ETFs as if they're the most positive thing in the world. But Martin, how do you choose the right ones?
Well, it depends on your investment objectives and so forth. I guess implicit in your question is that one should own ETFs. And one of the things that we have a problem with ETFs is that there's a real flaw in their whole nature, and that is that as an investment manager, to me, the most important thing is the investment merits of the component of the index. And for ETF manufacturers, they're most concerned about the liquidity. And so liquidity trumps all, which means that sometimes great investments don't end up inside the ETF.
Wow, interesting. And there's so many of them now. You have ridiculous names and things they're invested in. I think Wall Street has gone crazy with ETFs. They're out of control. So I want to ask you this question, Joe, which I think is probably the most important question for small investors, and that is this: what should you be willing to pay for a mutual fund or an ETF?
Well, I think if you're looking to invest in something very plain vanilla, very easy to understand, like an S&P 500 or the Dow Jones, a common average that everybody knows about, then you should pay as little as possible. So the simpler the investment, the less you should pay. We're huge proponents of saving money wherever you can. That's an easy place to do it. When you go into more interesting investments like small companies or international, things that are not as frequently known, then you might have to pay a little bit more money. So instead of paying 10 or 15 basis points or 1/10 of 1%, you might have to pay a little bit more than that. And what we recommend for people is, as soon as you can afford it, working with an advisor who can help direct you, because there are just so many choices and different ways to get similar investments, but it can make a huge difference whether you're in a low-cost fund or a mutual fund.
We're looking at, 10 basis points. 15 basis points, people. We're talking about very low-cost investments. Alan, to you, I want to turn now, change the topic a little bit, to bond funds. We've talked about what's going on in the bond market, the risks out there for small investors, many of whom have been so scared of stocks, they put everything into bonds and bond funds. What are you telling them now?
Stay out of long-term bonds for sure, because there's only one way interest rates are going to go up now, and that's up. So the longer the duration, the longer maturity on those bond funds, the more they're going to go down as interest rates go up. So that's the first rule, is to get out of long-term bonds. Second rule is, if you can afford to do so, really think about getting out of funds altogether and going to the individual assets in the funds themselves. Buy individual bonds and ladder them, because by laddering your bonds, you're going to have maturity dates that assure you that your principal is coming back, as long as the company is a good quality company. And as the principal comes back, you can reinvest into another bond at presumably a higher interest rate. So get out of those long-term bonds and go and really look hard at laddering bonds to protect your money.
I like laddering. Martin, what do you say? Is that the best advice?
Well, I totally agree with that. The only thing I might add is people have to also avoid things like electric utility stocks and REITs and other highly indebted companies, other types of investments that are heavily dependent upon the cost of money for their prosperity.
Joe,
hey,
I want to
super important.
Sure, go right ahead.
There are bond funds that have maturity dates in them, so if somebody wants the diversification of a bond fund, there are some buried treasures out there. You can go into bond funds that have maturity dates that avoid the hassle of laddering individual bonds.
All right, well, that's good news. Joe, Martin, and Alan, thanks for coming on tonight. Great stuff. Appreciate your time. We'll be right back.